NYSE Governance Services presents the Board Governance Series with series contributors Meridian Compensation Partners, Board Vantage, and Deloitte. On this edition, Busting the Paradigm, a new dawn for the board's involvement in transactions, with Hector Calzada, Managing Director, Deloitte Corporate Finance.
Hi, I'm Laura Finn, Web Editor of BoardMember.com. Thanks for watching this edition of the Board Governance Series. Today I'm seated with Hector Calzada. Hector is Managing Director of Deloitte Corporate Finance. Hector, thanks so much for being with me today.
That's my pleasure.
You spend a lot of time with boards, helping them through M&A transactions and having them think through the process. In the last decade, as the focus has really heightened on M&As, what have you noticed boards thinking about and considering?
It's an interesting time for boards with the markets at an all-time high, as we all know, and it's an exciting place to be thinking about that here. Boards need to be thinking about a greater level of scrutiny that can be applied in evaluating a transaction. Historically, boards have thought about how they review an investment banker's board package, typically seeing value reference ranges, a qualitative discussion around the deal rationale. And times are moving towards a direction where deal values have to be rationalized that much more than they were before. Height of the market, deal values in excess of 10 times EBITDA. Some deals are even in excess of 18 times right now. What that really means is what's driving value and how can boards evaluate that. So it's that very issue of how do boards actually insert themselves in this process of evaluating a deal that we're seeing a substantial amount of change.
And how can boards amend their behavior to embrace this time of heightened M&A deals?
Think about it this way. In rationalizing a transaction, one has to think about how two companies come together. So you're talking about deal synergies. And then those deal synergies get rationalized in terms of deal value. We think about it in terms of how a board digests a transaction. So there's a value proposition to shareholders. There's the actual deal rationalization or the value rationalization, and then the concept of is the deal fair. Boards are accustomed to seeing the fairness opinion, and boards are accustomed to seeing what the rationale is to shareholders in terms of why enter into the transaction. It's the interim component that we want to focus in on. What do they need to do to understand what those value levers are, how they can affect deal value, and how they can affect post-transaction performance.
Is there a process that you recommend to your boards that they follow?
Indeed there is. Indeed there is. I think historically, one would think about thinking about a transaction in terms of getting a book, again, from the investment banker, and then how do they ultimately digest what's being communicated in terms of that value relative to the deal price. Boards actually need to be thinking about greater amount of participation in the reports back to management and the company relative to the underlying diligence. Let's break it down into two pieces. Top line, you have revenue synergies and revenue component to the valuation itself. So how does a board think about what the projections are relative to how the company has performed historically, as well as what are the potential deal synergies? How are the two companies coming together? How are they going to rationalize the two companies actually extracting greater value in terms of revenue? Are they expanding geographically, expanding product, cross-referral sales? And then you have to actually think about the bottom line synergies as well, the cost synergies. This is an area that we've typically focused on the most, but boards are accustomed to seeing a general rationalization around the percentage of expense cuts that can be anticipated. Here, we actually want to see a greater level of scrutiny where your external consultants or management team actually step in and present their results to the board, at least in some summary level fashion, so the board can understand the impact again on value. How much of the value is predicated on those synergies? Ultimately, the board can then have a better understanding in terms of what potential risks are associated with the transaction, how does it impact value, and how can they actually monitor the transaction after the fact?
And that's a good question about after the fact. In a post-merger or post-acquisition, what can and what should the board be doing to make sure that they are unlocking all of the value?
Well, I referenced the concept of an outside consultant or a management team having an integration plan. There's going to be a timeline by which they're actually going to execute on that post-transaction integration plan. Having the ability to come back and review post-transaction integration and performance is essential to understanding go-forward processes in terms of how a board can evaluate a transaction. Said differently, was management able to actually execute on its plan relative to historical performance and relative to projected performance? And how does that lend to the credibility of the management team to be able to forecast new transaction synergies and the execution of integrating a new acquisition?
Hector, thank you so much for sharing your insights with us today. I think M&A is something that will just get hotter and hotter as this year goes on and we get into 2015, so I appreciate you being here with me on the trading floor.
Well, definitely appreciate it, and I'll actually add that according to our M&A review this past year, 84% of our respondents are expecting an uptick in M&A activity, so it remains to be seen.
Well, all the more reason to have you here, so thank you so much for your time. And thank you for watching this edition of the Board Governance Series.
Hector Calzada can be reached at hcalzada@deloitte.com. The Board Governance Series is a presentation of NYSE Governance Services.